Every time you tap on your phone to pay for coffee, you're participating in a race. Not of speed, but of data, infrastructure, and trillions of dollars on the line. On one side, the veterans, there is Visa and Mastercard, built over decades, running the plumbing of the global financial system. They don't lend, they don't sell, they just take a cut of everything. On the other side, the disruptors. Apple Pay, Google Pay, Amazon Pay. Owning your screen, owning your device, owning your daily habit. They don't care about the old rails. They want to build the new ones. This isn't just about payments anymore. It's about control. Who owns the customer? Who owns the data? Who owns the future? So today, we're diving into the real battle of Visa, MasterCard versus the modern fintech titans and who really owns the futures of payments. Chapter 1. Visa and MasterCard, the original rails. Imagine a business that earns money every time someone else takes a risk. Every time someone else lends money, every time someone else buys something, and this business, it just facilitates the flow. It doesn't deal with bad loans, it doesn't hold inventory, it doesn't advertise to you, it doesn't even care what you're buying. It just takes a cut out of everything. This isn't fiction, it's Visa and it's MasterCard, two of the most quietly dominant businesses on earth. And for the last 15 years, they have been the gold standard of compounders. In 2024, Visa processed over $16 trillion in payment volume and MasterCard around $9.8 trillion. Their combined market cap is now over $1.5 trillion. They're not flashy, but they're insanely profitable. Margins above 50%, zero credit losses, massive free cash flow. Their strength comes from a two-sided network. Merchants accept Visa, MasterCard because everyone uses them. Number two, consumer use them because every merchant accepts them. This flywheel has spun for decades, embedding them deep into the financial ecosystem. But now, new players are knocking at the door. Governments are building alternative, big tech wants in. So are Visa and MasterCard still unstoppable? Or are we witnessing the slow disruption of one of the capitalism's greatest machines ever? Well, let's find out. Now coming to chapter 2. The fintech frontline, the big tech's quiet takeover. Enter Apple Pay, Google Pay, Amazon Pay, and a dozen other fintech players. Let's be clear. Apple, Google, and Amazon didn't start as fintech companies, but today they're arguably three of the most powerful financial platforms on earth. And it's not just because of their users, it's because they control the interface, the data, the devices, and increasingly the rails. Apple, a fintech company hiding in plain sight. Apple basically controls over 2.2 billion active devices globally and nearly 1.5 billion iPhones. Now that's not just market share, that's wallet share. Because for Apple, your phone is the new credit card, but that's just the surface. Apple isn't just facilitating payments, it's rather going deeper. In 2019, it launched the Apple Card, issued with Goldman Sachs. As of 2024, Apple Card has over 12 billion users and is growing. In 2023, Apple introduced Apple Pay Later, its own BNPL product, skipping banks entirely, indirectly offering credit. Apple now holds $10 billion plus in customer deposit through its Apple savings account with Goldman Sachs, offering 4.15% APY more than most banks. In the backend, Apple has acquired Credit Kudos, a UK-based opening banking startup, and is rumored to be building its own credit risk engine. Apple is no longer just the interface, it's the wallet, the issuer, the underwriter, and potentially the bank. And with services revenue hitting $100 billion in FY 2023, finance is a core part of its future and not a side hustle. Now let's talk about Google, which is building the infrastructure of fintech at scale. Now, Google isn't issuing credit cards. It's going after the plumbing of digital payments globally. In the US, Google Pay, merged from Android Pay and Google Wallet, has over 25 million users and is embedded into Android, Gmail, Chrome, and Maps. In emerging markets like Indonesia, the Philippines, and Africa, Google is partnering with local banks and telecoms to put mobile-first finance. But the real story is in India, with UPI dominating the Indian payments, processing over 11 billion transactions per month in 2024. Google Pay sits atop at this infrastructure. While UPI itself is fee-free, Google monetizes via data, loans, and merchant services. It has launched merchant lending pilots with banks and NBFCs. It offers bill payment aggregation, loyalty rewards, personalized offers, effectively acting as a financial engagement layer. In 2020, it launched Google Plex, an initiative to partner with US banks for co-branded checking accounts. Later paused, but it does show the intent. Google doesn't want to be a bank, it wants to be the operating system for banks. And with Alphabet's investment in Ripple, Neom, it's quietly building a global position in financial APIs, remittances, and crypto payments. Now, let's talk about Amazon, Now, it's the Trojan horse in the commerce and credit. Amazon is often ignored in the fintech discussion. Now, that's a mistake. Amazon has over 300 million active consumers globally and over 2 million active third-party sellers on its marketplace. But behind the scenes, it's been building a serious fintech arm. On the consumer side, Amazon Pay has 50 million users globally. In India, Amazon Pay is deeply integrated with UPI, bill payments, and mobile recharges. It offers co-branded credit cards with ICICI Bank, with American Express, and other with over 2 million plus cards issued in India alone. It offers Amazon Pay Later with instant credit to millions of Indians of users. And on the merchant side, Amazon has built one of the largest merchant lending books globally. Over $20 billion have been so far lent to small businesses since inception, partnering with banks like Goldman Sachs to offer credit directly from the seller's central dashboard. It has also entered BNPL via partnerships with Affirm in the US and Rupify in India. And here's the killer stat. Amazon generates $50 to $70 billion in annual third-party seller volume. That's a massive float to monetize via credit, payments, and embedded services. Imagine combining Shopify's payments model with Apple's interface and Google's data. That's Amazon's roadmap. And with its own checkout layer, its own devices, Echo, Kindle, and its own loyalty engine, Amazon could bypass Visa Mastercard entirely for millions of transactions. These are not wallets, these are financial empires. The strategy is clear. Start at the top of the stack, the user. Then absorb the layers below, one service at a time. Visa and Mastercard might still be in the background, but increasingly, they are just a commodity rail beneath the tech's new interface. And once big tech owns the interface, they can route payments through cheaper options, bundle financial products with content, monetize credit deposits, lending and insurance, extract merchant fees directly. The disruption won't happen overnight, but it has already begun. The question is no longer will they enter payments, it's about how much finance will they own by 2030. Chapter 3. The real battlefield, which includes consumer control, merchant leverage, and regulation. Number 1. Consumer experience. Big tech has one massive advantage: user trust and habit. People trust Apple Pay more than the bank's clunky app. They use Google Pay daily for groceries, cabs, and rent. Amazon, it already has your card, your address, and your fingerprint. The battle is for habit formation, and big tech is winning that race. Visa and Mastercard have brand trust, yes. But do you, as a consumer, really choose them? Or do you just get issued a card? Number 2. Merchant relationships. This is where big tech gets even more dangerous. Merchants hate paying high interchange fees, which are sometimes up to 2 to 3% per transaction. Visa and Mastercard are often the culprits. So if Apple or Amazon offers lower cost rails or lets merchants avoid these fees altogether, merchants will push users towards those options. Number 3. Regulation and alternative rails. Governments are catching on. India's UPI has effectively made payments free. Visa and Mastercard's volume in India is shrinking. Europe is capping interchange fee, weakening their core monetization. Central bank digital currencies and open banking movements are creating direct-to-bank rails that bypass card networks. Visa and Mastercard's biggest strength is being challenged by speed, cost, and UX. In a few years, we may not need cards. We may not need networks. We may just need an app. Chapter 4. What's at stake? Profit pools, geopolitics, and the next $10 trillion shift. But why does this matter? Because whoever wins this race will control the flow of money in the digital age. Let's break down what's truly at stake. $500 billion in profit pools. Visa and Mastercard generated over $32.6 billion in net profits in 2024. Is that just the tip? When you consider merchant services, BNPL, credit underwriting, embedded finance, and cross-border payments, the profit pool balloons to over $500 billion globally. This is not a race for margins. It's a race for control over the most profitable layer of fintech. Visa and Mastercard generate over $30 to $40 billion in profit annually, because that's just the processing layer. Go deeper, and the real profit lies in credit issuance, lending, buy now, pay later, merchant services, embedded finance, and cross-border payments. Together, this ecosystem is worth over $500 billion in annual profits, and big tech wants it all. The developing world, a new battleground. Places like India, Brazil, and Southeast Asia are skipping credit cards entirely. They're going straight into real-time bank-to-bank transfers. Visa and Mastercard were slow to adapt. UPI in India now does 10x more volume than the cards combined. In Brazil, Pix is eating into cards volume rapidly. Meanwhile, Google Pay and PhonePe are riding on these rails, gaining massive user traction without paying interchange. The future doesn't need cards, it needs rails that are fast, cheap, and digitally native. The final verdict. Are Visa and Mastercard still the best compounders? So after all this, yes, but with an asterisk. They still own the rails in the much of the developed world, command loyalty from issuing banks, maintain unparalleled merchant acceptance, have margins and return on capital employed that fintechs can only dream of. They are cash machines. But the tailwinds that powered them, card adoption, digitization, global commerce, are no longer their monopoly. In the next 5 years, more and more payments will happen on mobile, move through direct bank transfers, be initiated by big tech, be regulated by governments, and avoid the toll booth altogether. The question is not whether Visa and Mastercard will disappear, it's whether they continue to grow at a pace of the modern digital economy or slowly become a commodity infrastructure. They're no longer the gatekeepers, they are vendors inside someone else's app. Still valuable, still dominant, but the compounder throne, it's no longer theirs by default. And if the future of money is shifting from cards to apps, from networks to ecosystems, then having the chance to invest in those changes is crucial. That is where Appreciate steps in, not as gatekeepers but as enablers. They have made it easy for Indian investors to access some of the biggest companies shaping this fintech revolution, whether it's Apple, Amazon, Google, or the payments giant themselves. No more dealing with complicated paperwork or worrying about remittance hurdles. With fractional shares starting at just 1 rupee, you can invest comfortably and flexibly, own exactly what fits your budget without needing to buy full shares. Plus, a curated research and market analysis keeps you ahead in the rapidly evolving global fintech landscape. Invest with Appreciate and be a part of the fintech revolution shaping the future. Thank you so much for watching this video, and also subscribe to our channel.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.